Alright folks, so I'm going to be going over the Wyckoff course and starting with the first study, but over time it'll cover the whole course. This is just something I'm doing just to basically build more expertise. And so I'll begin. The most important thing about the market is the trend, since we aim usually to operate in harmony with the trend. Study of our daily trend chart should be the starting point of all our deductions. There are three things here. The first is the most important thing to know about the market is trend. We aim to operate in harmony with the trend, but there's a reason for this. One reason is the risk to reward. If you're counter trending, always the reward will be very little and it'll be very much more random. That's the real reason. But when you trade with a trend, you can catch at least one swing, but most likely more than one swing. When you're counter trending, it's like a halfway back move, or less. So that's the real problem with, in my opinion, counter trending is the risk to reward move. Now, if you're counter trending on a higher time frame and then entering on a lower time frame, then that's a different story. But in general, counter trend trading also, you're going to experience a lot of other things like the pullbacks will tend to do more shakeouts, they'll have more springs, and that's like, and also on a short term time frame, it'll mess with your head in terms of trying to take position with trend and then counter trending, and then you kind of flip flop back and forth. So that flip flop, what it does, it changes your judgment a lot, and that messes with you, especially if you're doing on a shorter term time frame, because you're going long and then short and long and then short. So it's really important to be consistent. The next thing it says, starting point is the daily chart. It's very important. The daily is the starting point. A lot of people will start using like the monthly or the weekly or stuff like that. But you can see clearly he says here the daily trend chart, which is just like your SPY or the ES or the NQ. That's your starting point. So you have a starting point for your deductions. Alright, next. No one has yet derived the perfect average. All that means is you use the ES, NQ, or SPY. SPY, I think, is probably the best. And I'm saying that because a lot of the indications you'll see later here, you'll find it very clear and obvious in the SPY. A lot of other markets will not show it to you as clear as the SPY. And you can try that and you'll probably come to the same conclusion. Here's another point. It's a science, it's an art, not a science, etc., etc., etc. It's important for you to know this so that you will exercise judgment at all times in reading your trend chart. And this is also important, exercising judgment at all times. Believe me, if you try any indicators, they will fail. All indicators fail. You're going to have to use judgment somewhere or the other. It's just too much random variation and changes in volatility break all indicators. That's just the fact. But you can use, in my opinion, indicators to give you facts. So they can't make decisions, but they can give you facts. Like, okay, this is the range, or this is the amount of volume, or stuff like that. And your judgment must frequently be adjusted. Why? It needs to conform to what? Your wave chart and the group chart. So what are you seeing? You're seeing that he's using a daily trend chart, he's also using a wave chart, and he's also using a group chart. and individual stocks. So later on he's going to discuss that one market is not enough to decide what the market will do next, and that the group charts are is necessary to it's very hard to just use one market and say, okay, market will go up or down. Like if you just use the SPY or the ES, it's very hard. But if you start using the SPY or ES and then start using a bunch of group charts and watching the groups, you have more of an idea. That can be for many reasons, one of which is that groups don't move at the same time. Certain groups in, let's say, in healthcare or financial or whatever, the banks, some will go before other groups, so they will lead and other groups will follow them, and you'll see that too. Subject to above qualifications, etc., etc., etc. Alright, so here we start right here. We use the period from December 8 to December 17 as a starting point without regard to the market history previously recorded. The interval of 9 days marks a sharp acceleration of the previous major decline, culminating widespread of daily price range and very marked expansion in daily volume of trading as the market reaches its low point. All he's saying is a selling climax. So he's just taking a look at, okay, now I'm going to move over to the right hand side where there's a chart. You see the bars here? They're expanding. See, like little bar, little bigger bar, bigger bar. Volume little, more, more, much more. So it does this and then bang. Alright, right there. So that expansion in range and volume as it's reached making lower lows is telling you that it's climactic action. But do you know if that's the end? If that really is the climax? You won't know until there's a certain sequence, which includes testing. And I see this all the time in wave charts. It's like also very apparent. You use bar charts, wave charts. The principle is the same. It doesn't matter what chart you use. And all he's saying is that this reflects panic selling. So the selling climax is panic selling, which takes place under such conditions. Okay, the volume on the 8th was 2 million, and this increases to 5 million a day of the low point. Tape observers would have noted the fact that a large part of the volume of that 5 million occurred as the market recorded the extreme low and on the rally from the lows. What does that mean? So you have 5 million shares traded as the market makes a low. Of that 5 million, a significant portion is on the way up. Not just on the way down, but on the way up. That volume off the bottom, that change of behavior, that sign of strength, that buying, that demand, whatever you term it, is just illustrating that someone is buying the lows. That buying of the low, we'll just call it a change of behavior, is telling you that the climax has potentially passed. Why? Because buyers are stepping in. They are supporting price from the extreme lows. And he's saying here, tape observers would have noted that fact. Now that's another thing. If this chart is a daily chart, it means that you should also use an intraday chart. So you might have a daily and then an hourly chart will show you the volume on the way up. Even a 15-minute and possibly even a 5-minute will show you that volume coming in on the way up, but definitely an hourly will show you that market hit the low, and then from the low, the heavy buying came in. This confirms the fact that the climax of the downward movement has actually passed. What confirms it? The change of behavior. So as that climax low is tagged, is reached, heavy buying comes from that low. That heavy buying is your sign of strength or your change of behavior or demand or whatever, volume off the bottom, etc. But that demand that comes in as the climax occurs on heavy volume and spread and bar spread, meaning high-low range, from that point there's significant buying, and that buying is helping you confirm that the climax that was going down has ended. And now gives us a starting point of our next forecast. I don't know how he's going to do the next forecast right after that without that secondary test, but apparently he's saying that it gives the starting point for our next forecast. You won't be able to do it until it tests and makes a range or some type of count. I'll talk about that in a minute. A wave chart would also show the details of this tape action, including the feverish activity around the low point. All he's saying is it's going to go down and then it's going to go up where demand is coming in. We must now view in the above the trend is tentatively upward. Why? Why do you go from like heavy downward, prices going down, down, down with heavy price and volume spread, etc., to saying that, this is the low and prices will rise, the trend is up? Why would you even consider that notion? You consider it because of the demand that came in. That demand was the hand of the CM. That demand is telling you the climax has potentially passed, and that demand is telling you that you should think that you should consider that the downtrend has changed. So here he has a line that says, we must now assume, in view of the above. What above? What is above is that there's a climax low and then there's demand that coming from the low on heavy volume. Alright, so based on that fact, the trend is tentatively upward, but this is subject to confirmation. So there's an assumption that the trend is upward. The confirmation is yet to come. It will come, the confirmation will come on the appearance of what? Higher support on the next reaction. That is, if on the next downswing prices should break low through the turning point, it would be more and more selling. Okay, so what does this all break down into? It means that there's heavy selling, then there's buying. That buying makes you think or assume that the downtrend has ended and there's an uptrend that is going to be initiated. But you don't know that until the secondary test. That test of the climax, that if it holds, is telling you that prices are very likely going to go up. So that secondary test is confirmation. I would basically confirmation A. There's two confirmations. Don't ask me why. But one is a secondary test and the other is the higher high rally. So over here, he's saying that the trend is tentatively upward because of that sign of strength, but this is subject to confirmation by the appearance of higher support, meaning the pullback after the sign of strength has to hold. Now, if it breaks, that means the sign of strength is not a sign of strength, or it's very temporary and the selling is going to resume. Alright, now I'm going to show how this is going to look later on, but the point is, you see this move down here on the chart. Now the rally from it has to be on heavy volume. The pullback from it has to test the climax and has to have low volume. Okay, so this is the climax low. This is the high. The high is telling you to assume that the climax has passed. Why? Because of the demand that came in. And then you have the test on low volume. The low volume pullback here is the confirmation required to consider the market being in an uptrend. Alright, so now I'm going to go over the footnotes. Believe me, these footnotes are extremely important because a lot of people don't read them, but a lot of you can't really understand without the footnotes. All right. So the phenomenon of selling climax is caused by panic selling, which is matched against professional buying. So that's the change of behavior or volume off the bottom, or the demand that comes right after the climax. Large interest, etc., etc., etc. Okay, now what can that demand be? That demand after the climax, what are the possibilities now? It could be a number of things. Alright, either someone's buying the low, someone's short covering, or someone, by someone I mean the CM, is trying to stop the demoralization of the market. So the CM, when you see heavy buying after climax, it doesn't mean right away that the trend is up. There is potential reasons for it. The first of which is that if you have panic selling, you get the best prices and the CM is buying low. Second reason is someone is covering because the market has gone significantly low really fast. Why not cover your short positions? You're going to get good prices in the panic selling. Just cover. And the third reason is that the CM is just stopping the slaughter by providing temporary support. So what it means is that stocks either temporarily or more lastingly become large in strong hands. More lastingly because if the CM is buying low in order to sell high, it's more lasting. It's going to be an uptrend. It is temporary if it's just short covering, quick short covering, or it's just to prevent demoralization, further demoralization as the market will continue lower. Whatever the reason, it's either temporary or more lasting. In strong hands, an abnormal increase in volume is one of the characteristic symptoms of a selling climax, and supply and demand must expand sharply under these conditions. But the supply is now poor and demand of good quality, and since the force of supply will now have been exhausted. Why is it exhausted? Because of the climax. A technical rally ensues if buying on the break was principally for the purpose of supporting prices temporarily and checking a panic or relieving a panicky situation. This support stock will be thrown back on the market at the first favorable opportunity, usually on the technical rebound, which customarily follows a selling climax. All he's saying is that when there's a selling climax and there's a rebound, if the CM did that rebound, just if it's just an automatic rally, if it's just like a halfway back, if it's just a pullback because of short covering, etc., then heavy selling is going to come in and they're going to break the low. So there's going to be a climax, there's going to be a bullshit bounce or a dead cat bounce, and then the market will break if it's just temporary. And a new decline will occur. On the other hand, should a secondary test occur after the technical rally above reference to and prices hold around or above the climax lows while volume shrinks appreciably. Appreciably means significantly. We have an indication that liquidation was completed and support is again coming into the market. Therefore, the market behavior on these secondary reactions is usually indicative of the next important move. Very important here. A lot of folks will look for, a rally, a climax or something, and just make the judgment, oh yeah, it's ended because it's a climax or exhaustion or whatever. But what he's saying here is look for the secondary test. Why? Because the secondary test is going to tell you whether the market's going to go higher or not. It's a forecasting tool. If on the secondary test the volume is depleted and shrinks quote unquote appreciably, and the market holds, it is very likely that the market will be able to rally. Alright, and rally and possibly trend. Now, the other thing I want to mention about these secondary tests, in my opinion, the shortening of the thrust is also a secondary test. Many times I'll see a climax, and right after that I see like um, a little weak up wave or down wave, just that just slightly penetrates the climax and exceeds the climax but just a little. It's very weak, and that when that occurs, usually the bulls get aggressive and they do whatever they want to do. But in my opinion, that shortening of the thrust is a secondary test that kind of exceeds the climax just by a little bit. And I've seen it enough times. So, in connection, it should be noted that the same principles which apply to the larger swings also apply to smaller moves and to the day-to-day buying and selling waves. It's very true. Because all what he's saying here, I've seen it plenty of times in the hourly chart, 5-minute chart. On the hourly, it's very, it just happens a lot. These are principles. And he's saying that, hey, look, this happens. The same principles happen, not just on the daily chart, on the large swings, but on the smaller moves, on the day-to-day buying and selling waves. So a careful examination of your trend charts, group charts, and charts of individual stocks over a period of time will reveal numerous examples of the above phenomena. What he's saying is look at the charts over a period of time and you will see this phenomena. What phenomena? Well, climax, secondary tests, changes of behavior, etc., etc. However, you must allow for variations. Why? Because climaxes can occur over multiple days or multiple waves. So don't make them look exactly like the other. Meaning, don't expect them to look exactly like the other. There's variation. In my opinion, what I've seen is climaxes sometimes are defined by extremely high volume. Other times they're defined by very wide-ranging price swings. And the volume may not be as much as a prior up wave or whatever, but it's either through price or volume. So there's a lot of variation when it comes to climaxes. And whether they are climaxes or not climaxes, just look at that secondary test. And also, in my opinion, you have to take a look at the heavy demand that comes after, or the other side. You have to see the other side come in. They will not come in just by looking at a secondary test. So you need evidence that the other side is coming in. And so if the bears are selling, and you have a secondary, if you have a climax, then you have a secondary test, you still, in my opinion, need to see the bulls come in. Test or no test. So this will appear on all types of charts, all types of time frames. Alright, so now what is he saying? He's saying buying support comes in around or at a higher level than 135.5, which is low. 135.5. We may conclude that the demand is beginning to overcome supply. And the next logical development for final confirmation, this was the second confirmation I was talking about. What is the first confirmation? The first confirmation is the secondary test. Alright, so there's an assumption and two confirmations after the climax. Once you see a climax, you want to look for a change of behavior. The change of behavior is the assumption that the market will then reverse and trend up. The confirmation, or the first confirmation, is the secondary test. That secondary test is telling you that the market is going to go higher, and it is a confirmation. Then there's a final confirmation, which comes in the form of a higher high. So again, an assumption, a confirmation, and a final confirmation. The assumption is assumed after the change of behavior. The secondary test tells you is the confirmation, and then the higher high is the final confirmation. On January 3rd, these averages rise about 152. 152 is the high, so it makes a higher high, which gives the final confirmation of an upward swing that might develop into a rise of substantial proportions. Alright, so at this point, I'm right over here. Right there. That's the higher high. So now what's he going to say? He's going to say, alright, where do you buy? So these are entry rules or entry criteria. First, on December 17th, where the market made a selling climax, and at the same time there was a change of behavior, he's just saying on an intraday basis, once you have a climax and on the intraday basis there's a strong rally and a change of behavior, try to buy it. Okay, so climax on the daily, change of behavior on the hourly, buy the hourly with a stop below the daily low. Second buying opportunity is when the market completes 3 days of lower support, but closing prices of each of these days are between 140 and 141, showing that the selling pressure has lost its force, since the net result of these days pushing and pulling is very low. So where's the second buying opportunity? The second buying opportunity is right here. When the market pulls back, you see this kind of like ABC correction, and what you'll notice is that the closes, he's taking a look at the closes are clustered. Because the closes are clustered, it is an indication that the selling pressure has dissipated and it's just not there. And so he's going to say, alright, buy it. Why? Because there's no selling pressure. How is this known? Because of clustered closes that are unable to make downside progress. What about the other opportunity? The other opportunity is on the higher high. Alright, so he's saying a couple of things. Let's go back to the clustered closes. He's saying there's clustered closes and lower volume. Alright, so it's a clustered closes and lower volume, indicating that the secondary test has passed. Okay. The other thing to note is that the zone of support has broadened. All he's saying is that there's been a lot of bars. that are like not making downside progress. So he's looking at those bars. They're not making downside progress. They're not heavy volume, and there's not a lot of uh, pro- uh, progress in the closes. And the market, and why this is very important is because the market right now at that point is on the springboard. So how is he defining the springboard? He's defining the springboard as a secondary test of the climax that has passed, and it is also known as confirmation. Confirmation occurs when the market has climax, there's a change of behavior, and there's a pullback. That is a secondary test, and that secondary test shows that selling pressure has waned. Some of the evidences for this include clustered closes, low volume pullback, and a broadening zone of support. All that together with a higher support above the climax low sets up the springboard. And what's the third entry point? The third entry point is the rally, the higher high confirmation. So the higher high confirmation is what? Is the final confirmation. He says you can buy it. Basically, you can buy the new high or you can buy the higher high. But note that your stop is going to be is going to represent a lot of risk. So this is least favorable place because you're increasing your risk, but as you can see, he's ready to buy. Why is he ready to buy? Why? You have a climax, you have a sign of strength, you have a pullback, you have a springboard, and you have a higher high. So where is he? What have we learned from all of this? There are three Wyckoff entries. None of them are springs and none of them are up thrusts so far. That's important. The second thing we've learned is that the three entries are when the market has, by the way, springs and up thrusts are great, um, but you can't just draw levels and think that that you just do it like that. It's a little bit more complicated than that. Um, so I mean, there are triggers, and if you know how to use them, especially with trend. But what this study is saying, which is Wyckoff's own words, is that when there is a climax on this higher time frame on the daily, and there is buying off the lows coming from the tape or from hourly wave chart or whatever wave chart intraday, it is a buy. The climax followed by a change of behavior on an intraday basis is a buy. That's this point right here, somewhere in here. If you can get close enough near the lows. Where's the second? Second is on the springboard. What is the springboard? It is a secondary test of the climax low, which also has a sign of strength. And on that springboard, it has certain characteristics: low volume pullback, lack of progress in the closes, and a broadening zone of support. In my opinion, that broadening zone of support will look like cause on the point and figure chart. All of that together is telling you that the market is on a springboard. Third entry point right there. Why? Because it's a higher high. Higher high, you buy. I mean, it's the least favorable place to buy because your stop is pretty low, and the higher high is more risky. All right. So those are the three buy points. 1, 2, and 3. And that's it. So, I mean, you can use reverse logic and figure out what the selling points are. I'll go over that later. And that's all for today. Thanks.